Good afternoon and welcome to the first in our autumn series of webinars. Today's webinar is being hosted in conjunction with our colleagues from FTI, Greg Harman and John Lisle, as well as our in-house economist, Avias Ngwenya. Greg and John are no strangers to South African competition law. We've worked with them on a number of South African cases, including the Sasol excessive pricing case, and a number of other matters, including a recent case dealing with allegations of predatory pricing and inducements. Firstly, before we start the formal presentation, a few introductory remarks. And perhaps anyone who's listening, if you could turn to slides 3 and 4 of the presentation. The topic of conversation for today, namely excessive pricing and predatory pricing, are notoriously complex subjects from both an economic and competition law point of view. They're complex because the boundaries between robust lawful competition and anti-competitive excessive prices were at the other end of the spectrum, undercutting competitive prices and forcing rivals from the market, are some of the finest and more nuanced questions to determine absent a detailed economic analysis. The situation in South Africa is particularly complex because in predatory pricing scenarios, for example, the tribunal and the appeal court can apply two different tests in order to determine whether a company has engaged in a form of predation, depending on which section of the Act a claim is brought under. Today, we will try and determine and hopefully demystify some of the complexities surrounding predation and excessive pricing cases in South Africa. With the help of Greg, John and Avias, we'll seek to clarify some of these issues and hopefully make it a bit easier to understand the present state of the law. We're going to start off with excessive pricing, and Greg is going to take us through a few slides on excessive pricing. But before he begins, I want to raise a few issues for him to consider and hopefully to clarify during the course of his presentation on the topic. Now, there have been two decisions of the Competition Appeal Court in South Africa on the subject of excessive pricing. The first was the Mitchell Steel decision in 2009, where the court rejected the tribunal's novel attempt to fashion a structural basis for excessive pricing cases based on an approach which required a finding of superdominance allied with the notion that the market concern must be uncontested and incontestable. The court rapped the tribunal over the knuckles for creating a test which had no legal basis in the underlying statute. In the Mitchell case, the court suggested that the key concept of economic value should be determined by reference to the notional price of the good or service under assumed conditions of long-run competitive equilibrium. In calculating economic value, the court made it plain that economic value is a notional, objective, competitive market standard and not one derived from circumstances peculiar to the particular firm. The court also applied the criterion of economic value recognizes only the costs that can be recovered in long-run competitive equilibrium. In the subsequent Sasol case that followed thereafter, the court once again emphasized the complexity of these types of cases and that the determination of these types of cases involved a value judgment and that some deference was required. Now, a couple of questions emerge following the Sasol judgment, and these are a couple of issues that I've asked Greg to consider and to reflect on in the course of his presentation. The first is, did the court in the Sasol case adopt a slightly different standard or criterion from the one that is enunciated in the Mitchell case? In the Mitchell case, the suggestion was that the test to be applied was prices and costs under conditions of long-run competitive equilibrium, whereas in the Sasol case, the court seemed to adopt a more straightforward and conventional price-cost test. And the question, I guess, is, do we still look at issues of long-run competitive equilibrium, or did the court simply adopt a price-cost test in the Sasol case because that was a fairly straightforward approach to adopt in the particular circumstances of that case? That's question number one. The second question is, in cases involving excessive pricing, what is the difference between economic costs and accounting costs, and how are economic costs calculated? And clearly in excessive pricing cases, one makes a determination based on economic costs as opposed to accounting costs. The third question is that in the Sasol case, the court seemed to suggest that markups of up to 20% above economic value would not exceed the boundaries of reasonableness. Is this a correct reading of the decision? And is this in line with comparative European precedent? The fourth question is that when the court in Sasol indicated that a value judgment was required and that a degree of deference is needed and that a proportionality inquiry must be conducted to determine the reasonableness component of the test for excessive pricing, how does that get applied in practice? So those are the four questions for our expert, Greg, this afternoon, and I'm going to now hand over to Greg to present on excessive pricing. Before Greg begins, if anyone listening to this podcast has any questions, please feel free to send them through to us. We will answer all of the questions at the end of the presentation, but please feel free to send them through as the presentation goes along. And you can maximize the PowerPoint presentation by clicking on the far right-hand corner. Thanks, and over to Greg.
Thank you, Anthony. I think if we start on slide 7, I'd like to just outline, I think, at first, just some of the general problems that we face as an economist trying to determine when a price is excessive. Because, unfortunately, there are no generally accepted definitions in economics as to what an unfair or an excessive price is. So when we look to the guidance, we might have regard to what economists generally explain, that an excessive price are those prices that are significantly and persistently above competitive levels as a result of market power. But that raises instantly a number of difficult questions. How do we define significantly? How do we define persistently? And what is this competitive level? If we go further afield and look at Article 102A of the EU Treaty, it helpfully explains that dominant companies are prohibited from directly or indirectly imposing unfair purchase or selling prices. But what is this term unfair? How do we define that? That's not generally a matter of economics. And of course, we can then look to the European Court of Justice that's explained an excessive price has no reasonable relationship to the economic value of the product supplied. And here, what is meant by economic value and what is meant by the word unreasonable? So lots of difficult terms there for not only the lawyers, but also the economists to get their head round. So turning the slide, I think that it's important that before one even gets to the question of whether a price is excessive, there are a number of hurdles that need to be met. The first is the company obviously has to be dominant in the first place. But also generally precedent would tell us that it's difficult to find an excessive pricing case unless there is a so-called more involved. And what do I mean by that? Well, when we look through precedent, we generally find that excessive pricing cases come up when there's something else happening, such as the dominant firm has some special rights in terms of it has a statutory monopoly. Or maybe we're in a situation where consumers are locked into a product or service. We've certainly seen this in Europe presently with the pricing of drugs in the pharmaceutical sector. And we also see it obviously when we see dominant firms also engaging in exclusionary behavior. So we have to have a more, and we have to be dominant. But I think generally the nature of this presentation is to say, well, let's put those to one side because they're also very difficult factors to address. Normally they are addressed in court and it requires a review of the facts and there's legal questions. But I want to focus here primarily on when does a price start to look like it's excessive. And I think that it's important for companies who think that they might be dominant to understand whether their prices are likely to be dominant, because it's not a defense to say, well, I didn't know that I was dominant and I didn't know that my prices might be excessive. So what I'm going to try and go through is potentially some simple tools that would allow companies to try and address their situation of pricing and whether it might be excessive. So if we turn slides. Slide 9 just quickly addresses the question of dominance. And I don't intend to go into this in any detail, but Section 7 of the Competition Act in South Africa essentially says if you have over 45% market share in your defined market, then there is a presumption that you are dominant, and it doesn't matter even if you have market power, you're dominant. So we must have regard to your pricing. If you're between 35 and 45%, there's a presumption that you might be dominant unless you can show that you do not have market power. And the third limb of this says, well, if you're under 35%, you're not necessarily home and dry if it can be shown that you have market power. But often these cases come up when the dominant firm has market shares above 35%, and often the cases that I've been involved in involve companies that have market shares significantly above 45%. So if you're a company that falls into that type of market share, and obviously there are difficult questions of economics as to what is the market and how do you measure market shares, but if you're in that ballpark, then you should have regard to prices. And that's what I want to really address in this presentation. So as Anthony's already said, I mean, the Act defines an excessive price as a price for a good or a service which bears no reasonable relationship to economic value. And obviously, economic value has to be higher than the price for there to be an issue. So in determining an excessive price, we need to have regard to the price of the good, the economic value of the good. Having determined those two things, we have to compare them and understand whether there's a reasonable or unreasonable relationship. And then we also have to determine whether there is any detriment to consumers. So how do we define economic value? And as Anthony said, the two cases in South Africa have tended to define economic value by reference to economic cost. In Mittal, it was defined as the cost under a notional competitive norm, including a normal profit or return to shareholders derived from the firm's own long-run average costs after adjusting for inefficiencies and special advantages. The CAC in Sasol Chemicals provided some more context to economic value, and there it says, for the purpose of calculating costs, a notional objective standard should be utilized. And I'll come back to explain the slight differences between those, and then also hopefully answer Anthony's question with regard to, has economic value, the alignment on economic costs, appear to have moved away from this notion of costs under a long-term competitive norm. So on to the next slide. I mean, as an economist, when somebody talks about economic value, I would not normally alight upon economic cost as being necessarily the starting point. An economist would say economic cost is a supply side element, and that's only one part of the pricing equation. In economics, pricing is determined by the intersection of demand and supply. So only having regard to supply is only part of the problem. One has to think about demand side factors as well. And there's been a lot of precedent in Europe, starting with United Brands, but then going on from United Brands into cases such as Scadlines, which has recognized that prices may be above economic cost for legitimate competitive reasons. You may have some advantage that consumers are willing to purchase your products versus your competitors. And if you have that advantage, then you should be able to have a higher price. And that's why I think part of the test under United Brands allows you, having compared prices to costs, to consider whether your prices are unfair in comparison to other products in other markets. Because if you can compare your prices to other prices that are not deemed to be anti-competitive, then you are, kind of automatically looking at a comparison that is in this long-term competitive norm, and therefore is a valid reference point, which may suggest prices above cost. The problem often is that we are dealing with complex products in markets that are differentiated, and therefore we can't compare apples with apples, or in United brands, bananas with bananas. And we may end up comparing jackfruit with kumquats. But even in SCI, which was a relatively simple product in terms of propylene and polypropylene, where you think that you should be able to compare prices across markets, we found that difficult. And the CAC also found it difficult and decided that it didn't want to go through that test. So in South Africa, what we see is the precedent going towards this cost-based test. And there are two alternatives to it. The first is you look at the dominant firm's accounting costs. You convert accounting costs to economic costs, and then you adjust for any inefficiencies or special advantages. And later I'll explain why one might do that. Or one tries to model a hypothetical competitive market based on industry data. Now, why would you try to do that? You try to do that because in Mittal, we said that prices would be driven down to costs in a competitive market, in a notionally competitive market. So if you want to understand what prices might look like in a competitive market, you have to have a competitive market as your starting point. But obviously, by its nature, when we're looking at excessive prices, we don't have that position. So faced with those two alternatives, the CAC decided that when it was looking at Section 8A, which is dealing with a real, actual dominant firm, then in effect the monopolist costs become relevant. And I think that they are relevant. Even if you look at CAC in Mittal, it did say it's the cost of a competitor under a notional competitive norm, but it then also goes on to say derived from the firm's own long-run average costs, but then adjusted for inefficiencies and special advantages. And so it's difficult for me, obviously, to be able to interpret what and why the judge concludes what it did, and it would be irresponsible for me to try to do so. What I can say is that I think that if you start with economic cost as the lower bound for economic value, and you start with the dominant firm's own costs, then you're probably giving the lowest bound economic value that you can. And that may seem like you are not favoring the dominant company, but if you pass the test on that basis, then I think the court can be comforted that it's done enough and that's all it needs to do. And that's effectively what happened in the Sasol Polymers case, is even on this lowest bound, when we compared economic value to economic cost, the difference did not seem to be high enough to warrant judicial interference. Now, if economic value had been significantly lower than economic cost in that case, could the courts have come to a different conclusion? Then I think that there is enough in terms of economic thinking and what was said in Mittal for that question, still to be live. It could still raise its head in future cases if it becomes necessary to do so. But don't forget, we've had to cross a lot of hurdles already. We've had to cross the first hurdle of, is it dominant? The second hurdle as to whether there is a more. The third hurdle is now how do economic costs compare to economic value. So I think at the very least, one has regard to economic costs. We know that that is the lowest bound. I think there are good arguments in specific cases to argue that prices could be higher. There's then a question as to where that gets taken into account. And I think in all of this, we forget that when we go back to what the Act says, it says the price has to have no reasonable relationship to economic value. And if you're taking the worst possible position for the dominant firm, then when it comes to the reasonableness aspect, well, then you may be more generous in your interpretation. That's not particularly good for firms who have to have a special regard of their position and know how they're pricing, but obviously that is helpful if these cases go to court and somebody's being accused of excessive pricing. So if we jump on, and I can tell you now a little bit more about the price cost test, but as I go through, I'll also discuss where certain adjustments can be made that take us away from the dominant firm's costs to something that might look more like a firm's cost in a competitive market. Because I think adjustments can be made, as Mittal says, you start with the dominant firm and then you make incremental changes. I think what the courts can be allergic to is if you throw all of the dominant costs away and you alight on some new costs, because that may lack objectivity in many cases. In some cases it might not, but in others it may. So on slide 13, this just sets out the building blocks of how we start to talk about what is economic cost and what are we comparing it to. So the building blocks of economic costs are, we can start with accounting costs, and the first layer of costs will be the normal variable operating costs that a product or a service incurs. Those are normally well recorded within the accounts of a firm. There's then a question of fixed costs. Obviously, that is a cost that should go into economic costs. Many firms, unfortunately, don't allocate fixed costs between individual products. Some do, some don't. But if they don't, then there has to be an allocation of costs to the product under investigation. And of course, there is a question as to how one allocates costs and whether that's a reasonable way of allocating costs for these purposes. We then add depreciation. Why do we add depreciation? Well, if I invest in an asset for 100 Rand, then obviously over the life of that asset, I need as an investor to recover that 100. I need my money back. Depreciation is a way of amortizing that cost over time. And so there is a question as to, do we take accounting depreciation or do we take some kind of economic definition of depreciation over time? These are relevant considerations. And of course, one of the biggest differences between accounting cost and economic cost is, in economics, we think of the return on capital invested as being a cost. Nothing comes for free. If I borrow 100 Rands, I have to pay somebody for lending me that money. So variable cost, fixed cost, depreciation, reasonable return gives us a definition of economic cost that can then be compared to prices, or more generally, the level of revenues that a particular product earns. If revenue is above cost, there is something called economic profit. If economic cost is above price, obviously there's no economic profit, and that, I think, all other things being equal, would suggest that there is no evidence of excessive pricing. There can be circumstances where that is not true, but I think it would be fairly conclusive evidence that if your costs are higher than your price, then everything's fine. But John will then come and talk about predatory pricing, because if you get these things wrong, you're either pricing excessively or you're predating. Thankfully, that's not the world that we're in. But if the price is above economic cost, then there is a question, is that difference unreasonable? Now, there could be many reasons why there is a gap. One is because we've taken an extreme version of economic cost as our proxy for economic value. Economic cost is too low. The second is, I've just walked you through the calculation of return, depreciation. All of these things have complexity to them. There are measurement errors. So cost could be misstated for very good reasons. The third area is that there may be demand side factors that need to be taken into account. So that's why on the first slide, when I said that prices had to be significantly above, that resonates with what the Act says. Act says in terms of they have to be unreasonable. Then there is a value call as to what that level is. Now, unfortunately, I don't think there is an easy answer to that. It's not a mechanical test. I don't think that the Sasol Polymers case lays down a 20%. If you're above, you're fine. Below 20%, you're not fine. I think there could be all sorts of things that go into the mix in that question. So the facts of the case, were there other exclusionary acts or anti-competitive conduct? How much of a measurement issue is there likely to be? Have we been able to calculate important things like intangibles? What does the preponderance of evidence tell us when we bring everything together? So, I can imagine cases that could come out as being less than 20% as being the benchmark, but I can also see cases where it could be much higher. I've worked on a couple of cases recently in Europe, and without naming authorities, what they have on the back of their mind is below 20%. They don't think there's much of a case. Above 40%, they think they're on strong grounds. But I think that they recognise they could just be out when that comes to court. Reading what the CAC said, carefully, it said, below 20% didn't justify judicial interference. And for me, that kind of suggests that there can be, significant measurement errors that mean if you're under 20%, it could flip either way. But does that mean 30%? Sasol Polymers would have been fine, 40%? It's possible. But I don't think we have enough data points to know that with any certainty. So that's the basic building blocks. On slide 14, I basically just set out the types of issues that have to be thought about, and I'll just step through each of those as we flip through the presentation. So the first question is what is a reasonable return? And that's a reasonable question, I think. Most competition authorities will take one of two approaches depending on the types of businesses that they are looking at. And I think businesses fall into two camps. Ones which are capital intensive, manufacturing firms, mines, utilities, and then types of businesses that have less tangible assets. They're kind of asset light businesses. So for businesses that have a lot of assets sitting on their balance sheet, the typical way to determine the return is to say, well, you have a level of investment in your business, investments in tangible assets, intangible assets, and working capital. That is a proxy for how much money shareholders and debt holders have invested in the business, and they require a return on their assets. So level of investment, capital employed multiplied by their required return, something that we refer to as the weighted average cost of capital, gives the amount of return that investors require. For asset lighter companies, there is an approach called the return on sales approach, which is effectively says what margin do companies require, and that can be benchmarked, and we simply multiply that by revenue to come up with return. And I'll talk a little bit about both of those over the next couple of slides. I think that we're on the safest ground in economics and finance theory when we're dealing with firms that have lots of capital on their balance sheets. And many excessive pricing cases fall into this camp, and many forms of regulation are regulating firms with large capital bases. So we're in a world where the economic theory is quite well set out, and we know the battlegrounds. So simply speaking, the cost of capital, the weighted average cost of capital, reflects the reward that providers of capital require in return for making capital investments. Strong theoretical underpinning, granular calculations, it's transparent, been well debated. We should be able to alight on something between firms and the competition authorities, one would think, but there's always scope for argument, because actually at the end of the day the cost of capital is subjective, and there are some difficult issues that have to be determined, which I'll come on to. It's based on two factors: the cost of debt, generally easily determinable because firms should know what they pay for their debt, and the cost of capital, again, relatively easily determined. Most companies would use the capital asset pricing model to calculate a WACC for their business. They will have a WACC for their business because they will need to use that for investment purposes. How do they determine whether to invest? They will normally do that using a cost of capital. They also need a cost of capital if they're going to do an impairment review on their balance sheet. So this is a number that is, generally available to a firm. But again, obviously, it's being used in a different context, and so there's some slight adjustments are required when you come onto the economic cost side. Capital employed, starting point would be the balance sheet, fixed assets. I'll come on to say there's some difficulties with that. Intangible assets, generally not capitalized on the balance sheet. We have to think about intangible assets. We also have to include working capital. But simply speaking, it's relatively easy. We determine the level of investment and we multiply it by the cost of capital, and that gives us the profit element. I'll quickly say something on the return on sales. The return on sales, basically, the return on capital approach wouldn't work for a company that didn't have any investment. But you'd say, look, there's no assets in this business, so this business requires no return. But if you were to go to any stock market exchange and look at businesses that have very low levels of fixed assets, they will have a return. Obviously, they have a return. Nobody goes into business to no return. And that's because there are other things that are important. There may be intangibles that haven't been capitalized, but there also might be types of risks that are not capitalized on the balance sheet, like financial risk, assets at risk, that you may make a loss. And if there's a high chance that you may make a loss in your business, then you may need capital to be able to recover those losses. And that's certainly true when we're looking at financial services types of assets. Here, there is no theoretical foundation for working out what the return on sales should be. You cannot go to the capital asset pricing model for the return on sales. So what you have to do is you have to benchmark other companies. And you can do that by looking at their accounts and then determining what margins they earn. But there are a number of issues with that. It can be very difficult to compare asset to asset. So one example, you have to adjust for risk, for example. So I've done a case in the UK recently that was looking at the returns of a generic drug. So I can look at other pharmaceutical companies, but they have a portfolio of drugs, both branded and generic. So you have a question, if a company that has a portfolio of drugs, does that provide any reference to a single product that is generic? In that case, we argued it was very difficult to compare like with like in that particular situation. So difficult to adjust for risk. It's also difficult if your comparators are of different scale, because all other things being equal, if you are in a high volume-based business, then each product that you sell only needs a little bit of a margin, because all those little bits of margins add up into a big margin. But if you're shifting very small numbers of products, then each time you sell something, you need a very big margin. So think about a diamond. Diamonds, you would imagine there is some profit embedded in each diamond sale that is high, but the price of milk is low. So the profit in each unit of milk sold is low, but you've got high volume. So the problem with this approach is that even if you find a comparable, if they have a different scale, it is difficult to adjust for those types of things. So anyway, they are the types of things that one has to think about if they're using a return on sales approach. But also there's some issues on profits. And and I'll just highlight two. There's more than two. The first is that the way in which the weighted average cost of capital is determined using the capital asset pricing model is it starts with a market return and then adjusted for risk. But that's an average market return, and there's some questions as to whether that should be arithmetic averages or geometric averages, and all very exciting. But the point is, it's the average, and this is an average taken from all markets, hopefully most of them competitive. So why would you take a benchmark that is the average? Because there's going to be lots of companies who are earning above that average by definition, even if you adjust for risk. I know that the CAPM, you've got all sorts of risks in there, but so that seems wrong to me. If you just took the average, you would have no regard for the fact that there are lots of competitive companies earning a return above the average. So that's another reason why I think the Act will say it has to be unreasonable, because we know that you are allowed to earn above the average return. The second issue relates to specific risks. Every finance director will tell you that the weighted average cost of capital should only include market risk. It shouldn't include any specific risk in there. However, firms, when they invest, normally have an internal rate of return that is above their weighted average cost of capital, because they can't quantify all the specific risks that are meant to go into the cash flows. Now, competition authorities I think, have not been quick to recognize this. The CAC in Sasol Polymers was quick to recognize that this was a valid point, that if I go into a business and I can identify specific risks, I am taking risk at the inception of the project. I do not know how outcomes will actually manifest themselves. But when you observe excessive prices, well, you're doing so ex post, and those risks have manifested themselves either to the detriment or to the favor of to the company. So, if you were going into the umbrella business, and the state of the world turned out you were in England and it was always raining, then it may be that you seem very, very profitable. However, if I went into that business thinking, well, maybe half the time it was going to be sunny and it just didn't turn out to be, then there's a problem with the competition test, because you are observing a set of factors that when I made my investment, I did not know that's how the world would actually turn out. So you have this ex ante, ex post problem. And I think at least in South Africa, that has been identified as a legitimate thing that you should have regard for. There is a genuine question how you do that, and it's case by case. But there are techniques to try and to identify the level of that risk and include it in your calculation. So moving forward, hopefully I can now move through some of the other issues just at a little bit more pace. The first issue is around capital base. So what is the level of fixed assets that you are going to include? Has importance for two reasons, because it drives the level of depreciation and it also drives the return that investors should have. Most accounts, statutory accounts, are going to be performed on the historical cost basis. It's not always true. There's some industries that don't do it in that way, and they fair value their adjustments. And that just means that the value of the asset at the cost goes onto the balance sheet. So, question one, when I do my excessive pricing calculation, do I have regard to historical costs? The Competition Commission in South Africa in the past has started with that proposition. There's then two variations to that. At one extreme is the replacement cost standard, and that effectively says, what is the level of costs a new entrant would incur today, not the historical costs that were incurred yesterday. But if I, as a competitive entrant, was to come into the market today, what would I face? And that's important, because basically that is the bar at which we're trying to test a long-term competitive norm. Am I pricing excessively that if there were no barriers to entry and somebody could come into the marketplace, would my prices be high by reference to the cost at which that entrant would enter the marketplace? And there's another standard called the indexed historical cost. Really, that is a replacement cost methodology. It's just calculated slightly differently, which I'll explain on the next page. But let me first start to say, why is historical cost the wrong basis? And this occurred to me actually in a port case in the UK. And the problem is that if there's been inflation and these assets are long-lived, then the historical cost will have no relationship whatsoever to cost today. And so in this particular case, Port of Dover, there was a question as to what cost should the seawall be replaced. And it had a very low value in the Port of Dover's accounts, absolutely de minimis. Putting in a seawall today would be slightly higher. And it was determined that the relevant cost was not what somebody put in 100 years ago. That was their special advantage. They were there 100 years ago. They can't control inflation. They have to replace that asset at some point in time. And when they come to replace it, they'll have to replace it at the replacement cost. That's part of the argument, and the CAC did pick up on that on Sasol Polymers. But the real question is, if I'm hypotheticating a competitive market, then I have to think about the cost of entry. So this goes back to your question, Anthony, as to whether the CAC has departed from all notion of long-term competitive norms. I don't think it has obviously departed from it in total, because if it did, it wouldn't have reference to the cost of an entrant today. It would just stick at the cost of the incumbent. So I think we're moving there, and I think that we can move there because there are two approaches to calculating replacement costs that are objective. And the first objective approach is to say, I can classify my historical assets by category, and I can apply different indices to them, the indexed historical cost, to come up with an approximation for replacement costs. The second approach is a bit more bottom-up, the replacement cost. And that basically starts afresh from today and says, if I was going to replace my assets, how much would it cost? And in some industries, especially property portfolio-based businesses, they can do that because they will revalue those properties on an annual basis, if anything, for insurance purposes. So there are ways around calculating a replacement cost, either by using engineers, surveyors, evidence from insurance policies and the like, or one can look at indexed historical cost. I think the outcome from CAC in South Africa is basically we should have regard for replacement costs. Tick, economists would agree. Difficult to calculate. We should probably look at a number of proxies. And I think in the Commission's review of the private healthcare sector, I think we will see something that supports that general position and moving away from historical costs towards the acceptance of a replacement cost methodology. There is one tiny snag that the competition authorities have yet really to accept, but it's an obvious flaw in their arguments, and that is around intangible assets. The intangible assets are rarely fully recorded in the accounts of companies because the accountant standards are, against that. Auditors are prudent and conservative beasts, and one can understand why. It's an easy thing to manipulate, and people do not want the accounts to be manipulated. But there are types of intangible assets, like the value of customer lists and brands, and people obviously invest in processes and know-how and techniques that are all valuable. And if you think from an economic perspective, all of those are investments in a business that require a return on them. And the problem here is that often those intangible assets are invested at the beginning of a business. And the problem is that investigations normally happen when businesses are dominant and mature. And because people don't have perfect information, the time periods we look at are shorter, the last 5 years or the last 10 years, but a company may have been going for the last 20 years. So there's no inclusion of those intangible assets, the creation of those intangible assets when we come to perform the analysis. And I think from an economist point of view, we would say those costs should be included. They're rarely included because it's difficult. But if they're not included, then obviously when one thinks about reasonable relationships, then one has to bear in mind that intangibles may play a large part of determining whether the gap should be big or small, higher or lower than 20%. Okay. Transfer prices, can be a big issue. And in fact, I'm starting to believe that, they're the belle of the ball. They're the Cinderella of the analysis that is often, rather forgotten, unfortunately, but can actually have a very large impact. And the issue here is when a company is vertically integrated. And it can be vertically integrated across a tax jurisdiction or within one, and that may have some important issues associated with it. But effectively, A purchases from B at a transfer price, and A is accused of an excessive price. And the question is what do you do with that transfer price? Do you take it as given, right? It's in the accounts. Maybe it's been signed off by the tax authorities. I think the problem is that within transfer pricing, there's quite a lot of latitude to set a price, but that price could be higher or lower. And the tax authorities either accept it or by negotiation alight on a particular value. But really, if we're looking at excessive pricing, we need that to be an arm's length market price that is neither predatory or excessive in its own right. And I think that on cases that I've seen, it is quite possible for it to be either. In one set of industries, I see, especially when a business is incremental to its main business, it may set a low transfer price, so the profitability of the incremental business looks significant. But the problem is that if I was to have sold that intermediary product to an outside person, I may never have sold it at that low price. The second issue that we see is when companies relocate manufacturing for tax purposes. And when that happens, what we might see is that the transfer price may be too high, right? Because you want to land the profits in the low tax jurisdiction entity. And so I think there's a lot of things that are going on in transfer prices. In Sasol Polymers, where the transfer price was a big issue, I'm not going to go into that particular issue today because it's complex. We argued that the transfer price should be higher. The Competition Commission of South Africa argued that it should be significantly lower. And the Competition Appeals Court said, I'm going to place some weight on the price that you actually alighted upon. It was agreed by the tax authorities, but we would say it was within jurisdiction, so that probably doesn't tell us very much. But it was also in your accounts. Not sure that's a particularly good argument, given replacement costs aren't in your accounts either. So, we have to make adjustments where they're sensible to do so. But I think in the UK, the CMA is now starting to think carefully as to whether the transfer prices that are coming from different tax jurisdictions are a proper arm's length basis. So watch this space on transfer prices. But I think companies should think carefully as to their transfer prices and whether they're set at the right level. On the next two slides, I'm just going to talk about two issues at the same time: group costs and cost allocation. A firm, an entity, is likely to have some group costs that sit across a number of divisions and maybe even jurisdictions and countries. And at a product level, there's likely to be common costs that sit across different products. Probably fixed in nature, but difficult to allocate. So, if you thought about a woodwork shop that produces tables and chairs, they probably have a whole load of equipment for sawing, which is used in the manufacture of both of those products. If you do more chairs, it doesn't drive the cost of that fixed equipment in any other in any sensible way. But when we're thinking about economic costs, obviously that product that's in question has to have an allocation of group costs and it has to have an allocation of fixed and common costs. Now, I think there's two problems with this, and one of them comes back to your question, Anthony, about have we departed from the question of the company's own costs versus a long-term competitive norm. And I'm not sure that we have here. I mean, I think that the problem is that you can allocate costs on any number of bases. But the CAT in the UK has said there's no unique correct way of allocating these costs. On the one hand, I could say we should have absolute respect for the fact that on a standalone basis, you would incur all of those costs on that particular product. So we allocate all the costs there, and we can test the allocation based on standalone costs. Do you actually pass? On the other hand, we could say we're going to allocate very little costs to your business. There may be economic justification for that. I think the main issue here is kind of one of scale and scale efficiency. Because if you had group costs and I was a very large firm, then if I was to allocate by volumes, then I would end up allocating a very small amount of group costs to my particular product under investigation. If I then have a hypothetical competitive market, I have to come up with a question of what would that market look like. And if that market looked more like you in terms of size, then maybe that's right. But if that competitor was just a chair manufacturer and nothing else, then obviously that would be very different. So I think that when we come to cost allocation and the allocation of group costs, I do think that we have to have regard to what is the nature of our competitor so that we can come up with the right type of allocation that makes sense in a particular case. I think shorthand is that I'm saying that on Sasol polymers, we may have come to a conclusion that we use the dominant company's own costs, but there was a debate on how we allocate common costs and there was a debate on how we allocate group costs, and it was accepted that there was a number of different ways. So within that acceptance, we may be able to shoehorn in, if you like, the issue of competitive norms and what the competitor looks like, and therefore what is the right allocation of costs. But I think in short, one would try to determine cost allocation on a number of different bases, because I don't think you'd want to find excessive pricing on only one basis. So if there was 5 available bases of cost allocation and you only failed on one, I would say the preponderance of evidence suggests that it's not excessive. Okay, just a couple of more questions, points to go across. And the first one is efficiency and inefficiency. And again, I think this comes back to one of your comments, Anthony, that, I mean, Mittal said the accounting costs of the dominant company may reflect uncompetitive inefficiency. By extension, the accounting costs may be efficient. And effectively what Mittal says is that one still has to make adjustment for special advantages and the issue of efficiency. And I think, again, this is a question that says, if you weren't going to make those efficiency adjustments, then you would only be relying on the cost of the dominant supplier. Right? You wouldn't be going to any notion of what happens in a competitive market, because what happens in a competitive market, and this is well accepted in the UK, is that if I'm a business that is more efficient than anybody could be, then I should have the advantage of that efficiency. If nobody could ever match it, maybe because of scale, maybe because I have some process, then I do have to think about what the next competitor in the marketplace, how efficient would they be? What would their scale be? And if they can't match that, then I should be able to have that difference as an additional slug of economic profit. Because in a competitive market, I would price up to the cost of my competitor, or one pound below it, right? So I think the question of efficiency and special advantage allows us to adjust costs to move more towards the issue of what's happening in a competitive norm. So final issue, and that is of time period. I kind of explained that because of data constraints, we often only look at a very constrained period of time. And when somebody makes an investment, they do so for the life of that investment. So if I invested in a particular process and I had 20 years, I should be concerned about what prices look like over that 20 years. Was I excessive over 20 years? But if you come along and say, I'm only going to look at years 10 to 15, and I find that was a particular period of high profitability, well, that doesn't necessarily answer the question as to, well, what was the profits before? Do I have a cycle? Should I take that cycle into account? Were there startup losses that need to be taken into account? Now, it's a difficult question. Each case is different. I mean, it may well be that it's right to only look at a 5-year period if you've just excluded someone from the market and you're looking at the pricing behavior at that point in time. But I do think that one has to have regard to pricing over a complete period, because there isn't a general rule to say your price in any particular year has to match the cost in a particular year. That time period of a year is arbitrary. It's set by the fact that accounts are annual. Management accounts might be monthly. So I look at prices monthly. Maybe you would, but why don't I think about prices over a 2-year period or a 3-year period? So again, I think that it's important to think about different lengths of time. And one of the methods that I haven't explained is that you can do things in terms of return on capital and look at profitability and prices on an annual basis, but you can also look at things on an internal rate of return basis, which looks at profitability over a longer period of time, which is completely consistent with the kind of finance theory as to, when you would make investments, you make investments, whether it will be profitable over a particular period of time. Okay, so in conclusion, competition authorities generally have found it difficult to pursue actions of excessive pricing because there's multiple steps in terms of, are you dominant? Is there are your prices excessive when we actually do the price cost test? I think that there has been some guidance between the Mittal and Sasol polymers. I think that by setting costs with respect to economic cost of the dominant supplier is good in that it's objective and it will allow companies to go and do a very quick test to compare their prices to their costs. I think that if they find that their prices are above their costs, that's not an immediate moment for alarm, because there's many factors that might explain that. And some of them might be because we're not looking at the right standard in terms of we do want to think about things in a more economic way, or we want to look at demand side factors, and that might be a reasonable inclusion, and or because we're not quite modeling the market correctly in terms of we're observing a world where there's only one supplier, and that's detrimental to the overall calculation. It's the lowest of the lowest bounds. But anyway, I hope that's helpful. I hope that I've answered your questions.
Thank you, Greg. I think that was extremely helpful, and I think you answered all of my questions. And I think we're now going to turn to the next section of the presentation, which deals with predatory pricing, and John's going to take us through that. Before John kicks off, again, a few very brief introductory remarks. So we've had the very recent decision of the Competition Appeal Court in the Media 24 case. And that was an interesting case because although the Competition Tribunal found for the Commission in that case, they effectively found that Media 24 had engaged in exclusionary conduct and applied the sort of lesser, for want of a better word, predatory pricing test under Section 8C of the Act. That finding was overturned on appeal, and the Competition Appeal Court ultimately came to the view that no case had been made out for predatory pricing, either under Section 8C4 on the marginal average variable cost test, or under the lesser test under Section 8C. And what I'm going to ask John just to take us through when he talks about predatory pricing is what are the two types of tests that are applied under Section 8C and under Section 8D4, because clearly there are different standards and different tests which are now applied. So we're in this unique position in South Africa where we effectively have two different types of predatory pricing tests, depending on which section of the Act you look at them. Secondly, it looks like from the court's decision that intention is no longer a relevant consideration. The court seems to have dismissed the tribunal's notion that the intention of the dominant firm is a relevant consideration and seems to have suggested that it's simply an objective analysis and intention is no longer a relevant consideration. And John, you'll tell us whether you agree with whether that's correct. And thirdly, and this is a more esoteric question, is how difficult are predatory pricing cases to prove these days? Because the suggestion in the Competition Appeal Court's decision in Media 24 is that provided a dominant firm can show that its incremental profits exceed its incremental costs of a particular good or service, that then there's no case to be made out of predatory pricing. And in large firms where incremental costs may be relatively small, that would suggest that predatory pricing cases are very difficult to prove. So those are the 3 points that I wanted to raise for consideration, but over to John. And John, can you take us through?
Anthony, thank you. So I think before we get into answering some of those questions, I'd like to start with a couple of slides that set out some background so that we're all talking at the same level, singing from the same hymn sheet. So in terms of what is predatory pricing, it's important to understand that with predatory pricing, what we're dealing with here is a situation in which a dominant firm, and we've talked already this evening about sort of the definitions of dominance in the South African context, where a dominant firm makes a deliberate sacrifice of revenues in the short term for the purpose of driving out a rival or preventing the entry of a rival with the view that it will recoup those losses through higher profits to be earned in the environment in which it is experiencing a lesser degree of competition. The European Union Commission is very much more explicit in terms of saying that it must always entail a sacrifice. And from this implies that the dominant undertaking is deliberately incurring losses in the short term. Right? It's an active decision. It's not a case of a mistake is being made. And that, as a corollary of that, that the loss could have been avoided, i.e. so you made a conscious decision to set a price when measured against the relevant level of cost is going to generate a loss. And that, a bit like what Greg's just been talking about in terms of the price cost test for excessive pricing, means that how you measure price and how you measure cost is particularly very, very important in considering potential cases of predatory pricing. Now, as Anthony alluded to in his introductory remarks, the current Competition Act in South Africa has, in Section 8D4, a very specific prohibition against predatory pricing and defines predatory pricing in terms of selling goods or services at below their marginal or average variable cost. And I'll come in a bit more detail in a few minutes to what those definitions of cost actually mean. And then separately, under 8C, there is the general exclusionary or catch-all provision that prevents a dominant firm from committing any act that impedes or prevents a firm from entering into or expanding the market. Now, obviously, that is a more general provision. I'm speaking here as an economist, not as a lawyer, but it does seem that predation is automatically a subset of that in the way it's drafted. And why does this matter, and why does the relevant cost standard matter? Because what we're worried about with predation is the deliberate attempt to exclude a competitor from the market, with a general presumption that proliferation of competitors will help drive efficiency, will help drive customer choice, and will help drive down prices. all of which is to the benefit of consumers. And therefore, there is a fine line to be walked between setting rules that would discourage competitors from actively competing in a fair and legitimate way to the benefit of consumers, and undertaking conduct that will eliminate competition to the detriment of consumers. And that's why this is an area that has attracted so much interest, because it is one where the authorities are walking a very fine line between trying to balance the interests of consumers and where those are best served at any point in time. And a lot of this comes down to assessing where the prices sit relevant compared to the relevant cost benchmarks. So what are these cost benchmarks? Well, if we look on the next slide, there are 4 costs or benchmarks here that I'll talk you through. To the left-hand side, we have average variable costs. That's one of the 2 definitions referred to in section 8D4, the other being marginal cost. So average variable cost is effectively taking the variable costs incurred in the production or provision of a good or the provision of a service and dividing it by the number of units that are being produced. The marginal cost is the cost of the last unit of production, and they may not be the same. So, for example, if you're buying in raw materials from a manufacturing process, and as you scale up, you're getting bigger and bigger discounts from your supplier, the unit cost of your input will go down, and therefore the marginal cost may be considerably lower than the average variable cost. And as you scale up production, average variable cost, all other things being equal, may fall over time. So that is the test in 8D4 under the current legislation in South Africa. The next measure that is considered around the world in the context of predatory pricing is what's called average avoidable cost, abbreviated to AAC. What does this include? Well, this includes the fixed and capital costs that could be avoided in the medium term were you to cease providing the good or service under investigation. Hence the term avoided. So you look at what your costs are and you try and identify what those costs, how those costs would fall away if you cease production of the product or goods or service. As we'll come to later, this is not an easy exercise. It's not a standard accounting measure, and it's potentially very different from business to business, and even within a business, depending on the scale of operations of different products, what you would avoid by ceasing to produce a particular product, even within one factory, may be different from what you would avoid if you stopped making a different product. The next block up is what's called long-run average incremental cost, and this it can be contrasted with the average avoidable costs in the sense that it includes all the costs that you did incur going into the business. So in some ways, it's what cost did you add in total to start supplying this product or service, as opposed to the cost you would avoid were you to cease. And therefore, crucially, it includes all the costs typically incurred to establish a business. And coming back to what Greg was talking about, the sort of full economic costs, it includes the capital costs associated with establishing the business. And the fact, from an economics perspective, some of those costs include both the return of that capital by way of depreciation and the return of that capital, by way of profit or return on capital employed. Again, this is very, very specific to a company or to its product or to, indeed within a plant. One of the cases I've worked on where this is a big issue is in the fast-moving consumer goods sector, particularly with sort of manufacturers of carbonated soft drinks, where you have a range of different products all of which can be made using the same equipment. But actually, you started out producing cola, or you started out producing lemonade, and that's where the big capital cost is, because that's 80 or 90% of the volume. And all the small additional flavors you might produce, actually have the average avoidable cost and the lyric may look very similar for minority products, but when you're dealing with a bulk product, they could look very different. And finally, on the right-hand side, we have what's called average total cost. And as Greg was just talking about earlier, in terms of the allocation of common costs and corporate costs, an average total cost takes the lyric and effectively adds to it some share of those common costs. Now, there is no absolutely right way of allocating those costs. And in many cases, they are not directly attributable to any particular product. The most obvious example being the chief executive's salary. How you share that out across different products actually is a matter of accounting convenience or the purpose for which you're doing it. But the cost is fixed, and the cost is likely to be constant over any reasonable scale of operations. So where does that get us to in terms of the context of the Media 24 case that Anthony mentioned? For those of you who are not familiar with the details of the Media 24 case, a few sort of points of background. This case involves the local newspaper industry in the Free State, and it was a complaint brought by the operator of one newspaper by the name of GNN against Media 24. Media 24, over the relevant period in the mid-2000s, operated two newspapers in the Velcom area, Forum and Vista. And GNN's allegation and complaint to the Competition Commission was that Media 24 had deliberately reduced the prices it charged for advertising, which in local newspapers is the key source of income, because many of these papers are distributed for free, to a point where it was charging below cost, and that this was being done with the deliberate intent of driving GNN out. As actually happened, GNN did close in 2009, and shortly thereafter, Media 24 shut down Forum, leaving Vista as its only paper operating in the area, and indeed the only local paper operating in that market. Following GNN's complaint and the Competition Commission's investigation, the CC referred the matter to the Competition Tribunal on the basis that its conduct, Media 24's conduct, was in breach of both Section 8D4 and, alternatively, 8C, and therefore it was effectively taking a two-pronged approach here. Media 24's position all the way along the line was that Forum was loss-making if you looked at it at the average total cost basis, as per my last slide, but that it was profitable when you looked at the revenues and compared these to the incremental costs associated with that title. Media 24 being a large group, it has a number of many local newspapers, and its argument all along the way was that actually having an additional title did not force it to incur many additional incremental costs, because many of the functions like accounting, revenue, billing, some of the journalists, etc., were shared across multiple titles, and actually, with or without Forum, those costs didn't vary very much. What the tribunal found was that in relation to 8D4, the prices that were being charged were considerably in excess of average variable cost or marginal costs, and that there was no breach of 8D4. But what it found in relation to 8C was that Media 24 had priced at below average total costs, and that, more importantly, it had done so with the deliberate intent to drive GNN out of the market. Now, Media 24 appealed this, and it was heard before the Competition Appeal Courts, and in March this year, the Competition Appeal Court issued its ruling. Now, somewhat uncontroversially, it confirmed the applicability of average variable cost and or marginal cost as the relevant test for predation under 8D4. So it's confirming what the Competition Tribunal had already held. Potentially most importantly, for some practitioners, what they found was that intent was not relevant to the analysis under the Competition Act in South Africa. And that the test under the legislation was one based on effect rather than the intent of the operators. So at that point, what the Competition Appeal Court had dealt with was effectively dropped the average total cost of with intent and had dealt with the with intent, and then proceeded to deal with the average total cost. Now, what the Competition Appeal Court found here was that average total cost was too strict a standard. Coming back to what I talked about earlier in terms of walking this fine line between abusing the development, abusing participants in the market and preventing entry, and not acting in a way that is to the detriment of fair and legitimate competition and consumer welfare. It found that average total cost was too high. It would actually deter potentially efficient actions and legitimate competition on the part of dominant firms. And therefore, where it moved to in its ruling was consistent with sort of much international precedent and economic literature. It held that under 8C, the average avoidable cost is the relevant metric, because that represents the cost that would be incurred by an equally efficient entrant or competitor, and that charge below that would be predation, but up to or equal to average avoidable cost was the right side of the line in terms of balancing the competitive interest and the interest of consumers. There was a lot of toing and froing between the parties around what actually goes into average avoidable cost. The Commission had views on certain subjects. Media 24 had views on other things, particularly, as I said, around what cost would generally fall away if you took out one small newspaper out of the entire stable. But potentially most importantly, in terms of setting precedent, what the Competition Appeal Court said is that you look to the actual costs incurred, and they rejected the inclusion of an opportunity cost or profit foregone from an alternative business in the inclusion of average avoidable costs. So again, this is firmly rooted in your starting point is what is actually recorded in the books. Whether you adjust it for changes in asset values or other sensible and legitimate adjustments, what you're dealing with is at least real costs rather than notional costs. And finally, obviously, on the basis that what it was dealing with before it was the evidence, it found that charges being levied by Media 24 were in excess of its average avoidable costs, and therefore the Commission, the Tribunal's case failed. So, in summary, where does this leave us? Well, in terms of answering Anthony's questions, I think it provides us with confirmation that under 8D4, average variable cost or marginal cost, as written in the Act, and the current version of the Act, I know you're going to say something on that in a minute, remains the test. Where it seems to get us to is that intent under South African law isn't the issue, it's an objective, effect-based test, and that in terms of the general exclusionary provisions of 8C, that average avoidable costs is the relevant benchmark to be applied. I think that's helpful in the sense, a bit the way like Fassel is on excessive pricing. It gives companies under the current legislation some guidance as to where they should be looking and what they should be testing for. But as I mentioned, I mean, because average avoidable cost is not an easy to look up number in terms of you can't get it out of the statutory financial statements, you won't get it out of the management accounts, and it is very much context specific. applying that test is not necessarily going to be straightforward.
John, thank you. That was extremely helpful, and I think we've clarified what the existing state of the law is. All of this, of course, may be thrown into some disarray because after the very helpful clarifications that you and Greg have offered on excessive and predatory pricing respectively, there are certain amendments that have been proposed to the Competition Act, and I'm going to go through those very quickly and then ask Avias to sum up our discussion of today. Why are these amendments being proposed? Well, government has suggested that the Act hasn't perhaps been as effective as government would have liked or hoped in addressing issues of concentration and racially skewed spread of ownership in the country. And that some of the amendments that have been proposed to the Act will perhaps address these issues in a more immediate way than the current legislation. And we want to look very briefly this afternoon at what are the amendments that are proposed in relation to excessive pricing and predatory pricing in particular. And there are a couple of amendments. The one in relation to excessive pricing is to delete the requirement of showing that there is detriment to consumers as a consequence of the excessive pricing in question. Now, I think the jury is out about how important a deletion that would be if it actually came into effect. Because in practice, in cases that have been argued to date, whether it's Mattel or Sasol, I think implicitly it's been assumed that if you can prove an excessive price, inherently that will be to the detriment of consumers in any way. So I think it's unlikely that this deletion is really going to make a significant difference at the end of the day from a practical point of view. There may be some debate about this issue, but I think in practice it's perhaps unlikely that this will really make a material difference. What will make a material difference is the reverse onus provision, which may be introduced under Section 8D2, because what that basically implies is that what the Commission has to do is make out a prima facie case of excessive pricing. But once it's made out a prima facie case, effectively the onus then shifts to the dominant firm to show that its price was reasonable. And this creates, I think, quite a difficult onus for the dominant firm, because there's a difference between the Commission having to prove that a price exceeds economic value and that there's no reasonable relationship to economic value. And that, in a sense, is quite a high threshold for the Commission to discharge. But for the dominant firm to show that its price is reasonable is altogether a different test, because we then start getting into the terrain which is more similar to the terrain in Europe. But is a price unfair? Is it reasonable? And that becomes far more of a value judgment and a discretionary test than the type of test that Greg outlined about economic value. So this, we think, will have a significant impact on the standard of proof and on the onus if it were to come into operation. And then lastly, what's also been proposed is that the Commission will publish guidelines setting out the relevant factors and benchmarks for determining whether a price is excessive. Now, this is again a rather curious addition, because we already, as discussed by Greg in his presentation, we already have significant guidance by the courts in both Mattel and Sasol about the types of tests that should be applied, the types of criteria that both the tribunal and the Commission should take into account in determining whether a price is excessive. And it begs the question then, well, what will the Commission be doing with these guidelines? Will they simply be replicating what the court has already said in Mattel and in Sasol? Will it simply be a restatement of those principles, perhaps in a more easy to understand or user-friendly guide? Or will the Commission be setting out its own guidelines, which are different to those of the court? And if those are different to those of the court, it then raises the question, well, how will this then all work in practice? Will the tribunal and the court then have to have regard to the Commission's guidelines, notwithstanding the previous precedent of the appeal court? And that would seem to subvert the hierarchy of precedents and everything else. So this is a rather strange provision, and it's not clear what is intended by this. The other change insofar as predatory pricing is concerned is the proposal is to delete the catch-all provision under Section 8C, as John has indicated, and instead under Section 84 to have a range of potential approaches to determining predatory pricing, which would include pricing below average avoidable cost, long-run incremental cost, or average variable cost. So effectively applying a number of tests which could be taken into account in determining predatory pricing. So in other words, the range of potential tests which could be applied is potentially extended. That brings us to an end of the presentation. I hope that it's been useful in certainly clarifying the existing state of the law and potentially raising some questions of what could occur if the amendments were to come into account. I'm going to ask in the last 5 minutes that are available to us for Avias, our in-house economist, just to round up the session and perhaps end with a few closing thoughts before we end off the session.
Thanks, Anthony. I think firstly, thanks to Greg and to John for the very insightful presentation and walk through excessive pricing and predatory pricing. I certainly am of the view that it's going to provide a lot of guidance to a lot of individuals who find it difficult to understand, are you on the wrong side of this threshold? Are you too low or are you too high, and what should you be thinking about? And just to sum up from the perspective of excessive pricing, it's really to understand a few points. Firstly, these are complex analyses, and from the perspective of firms that believe that they may be in dominant positions, I think it's incumbent on them to understand where they stand. I think as with Europe and South Africa, firms have a special responsibility not to abuse what they believe to be a dominant position, and really understanding what the economic costs are and whether or not your revenues are significantly greater than those economic costs is important from a firm-specific perspective to engage in that exercise. And I think some of the points which Greg has made around really understanding things like transfer pricing, how you price, whether you price for tax purposes, can have an impact on whether or not you're viewed as pricing excessively because you've chosen to earn returns in a particular jurisdiction vis-a-vis another. And it'll be interesting to see how South African jurisdiction deals with that particular issue going forward when additional cases get brought. I think Anthony's raised an important question around what the relevant test is. Is it as simple as a price-cost test that was applied in Sasol? Or do we really have to model a long-run competitive equilibrium? I think Greg's insights into that to say it's neither one or the other, but it's a bit of both, is useful for firms to think about, maybe using a litmus test of a price-cost test, but understanding that in cases where you do see some sort of excessive benchmark, then digging a bit deeper and trying to understand whether you would pass muster on a long-run competitive equilibrium. I think that's the big insight there. And then turning to predatory pricing, I think firstly, the developments from the Media 24 case are very significant from a South African perspective. I think where historically competition authorities may have viewed a sort of pricing between average total cost and some measure of variability or avoidable cost as being predatory, I think a lot of firms will find comfort in the fact that the test in South Africa is now slightly more stringent. And if you price below average total cost, but above a measure of variability or measure of avoidability, you're safe, is the current take from the existing case precedent. But then again, you have to take into account Anthony's slide on predatory pricing and what will happen to the amendments and the impact those amendments will have on firms' pricing behavior going forward. I think the key one for me is the movement of avoidable costs into an 8D5 assessment versus where the CAC has it now as an 8C, and how firms will view predatory pricing in that world. But overall, I just have to say thanks to Greg and thanks to John for the very, very insightful remarks.
Thank you, gentlemen, and thank you to everyone who dialed in this evening. And we are signing off officially from Johannesburg. Yep. Goodbye and good night.